Well, hello, everyone. Welcome to Fridays with Vistage. My name is Bill Black. I am a certified exit planner, and as the announcer said, I'm the host of the Exit Coach radio show here in Los Angeles, where I've interviewed over 1,000 advisors, and I'm also a member of Vistage. I'm a member of Vistage Trusted Advisors Group number 1244 here in Irvine, California, and it's my pleasure to moderate today's session. We're going to talk today about a very important topic, private company valuation. Now, understanding the value of your business puts you in a position to take advantage of market conditions and to build out options for your next step. Determining the value of a business, however, can be an opaque and somewhat subjective process. So it's important that as a CEO that you understand how to approximate what your business is really worth to both manage your own expectations and to help bankers and investors see the value of your company. So in this session, we're going to talk about strategies for private company valuations and to identify levers to continue building value. And you're in incredible luck today because our speaker is Peter Lehrman, who is the CEO of Axial. And Axial is a network that enables middle-market private companies to intelligently connect with the advisors and capital partners they need to meet their goals. And in his capacity as CEO, Peter is responsible for driving the company's vision and strategy in becoming the trusted platform for those who run, advise, finance, and acquire private companies. I've been to their website. It is phenomenal. You've got to go check it out. Now, Peter's a technology, strategy, product marketing, sales, and online expert. He's an entrepreneur and investor. He's had more than 10 years of experience. And prior to Axial, Peter worked in private equity at SFW Capital Partners, where he observed firsthand the challenges and inefficiencies of accessing private capital in the massively fragmented middle market. Before SFW, Peter was part of the founding team at Gerson Lehrman Group, where he helped build the company's dominant global technology platform for on-demand business expertise. Now, before we turn it over, I want to remind you that you can submit your questions in the Q&A box, and we'll be monitoring those questions, and we'll address those at the end. So, Peter Lehrman, the floor is yours.
Bill, thank you so much for introducing me, and for I want to thank Vistage for having me back on for another Fridays with Vistage session. It's great to be with you all. We're going to spend about 40 minutes walking through a set of slides that I've pulled together to really help you understand the frameworks by which private companies are valued. Before we get into the slides, I want to make it really clear that there's going to be nothing in these slides that gives you the answer to, what is the value of your unique company. Every company is like a fingerprint. It's unique and it's totally different. And depending on how you value your business and depending on when you're valuing your business, you're going to have different outputs and different answers. And so what's really important I think, for the entrepreneurs to understand that are on this webinar and that are part of the entrepreneurial community is valuation is totally unique to your business, and it's also unique to a particular point in time. Businesses can be more valuable today than they were yesterday or less valuable. And so I'm going to walk through some of the really important frameworks that you need to understand in order to begin to arrive at a valuation for your business and to be able to estimate it. If you want to catch up with me offline, I'm going to make some tools available at the end, as well as my direct contact information, and hopefully that makes things easier for you if you have some follow-up. But let's jump in. We'll spend about 35, 40 minutes going through the slides, and then there are about 15 questions that I got from attendees, and I want to make sure that I leave time for all of those questions and any others that come up during the course of the webinar. So we'll jump in. And I'm going to start advancing through the slides. So we're going to cover the two kinds of valuation frameworks today. There's an estimation-based framework, and then there's the market-based framework for valuation. I'm just going to talk about when you use the one and when you use the other. It's very important to understand that. I'm going to cover 3 different methods by which to use the estimation-based framework. So there's a couple different ways that you can use estimation-based valuation frameworks. I'm going to talk a little bit about when to be valuing your company, and then I want to conclude my prepared remarks with a clear sort of articulation of what market-based valuation means. That's very important that entrepreneurs understand what that means and also understand what the implications are of doing that. And then, like I said, we'll spend at least 10-15 minutes on Q&A from the questions today, as well as the questions that were put out in advance. So let's jump in. Get to my next slide here. So just to give you all a little bit of context for who I am and the business that I have been running, I started Axial about 5 or 6 years ago. Axial is an online platform that connects CEOs with capital to help you finance growth or to sell your business. And we became Vistage's national partner around valuation, exit strategy, and financing growth initiatives about 2 years ago. So we provide our platform to Vistage members with a variety of preferred options. And we work with the Vistage chair community and directly with Vistage CEOs to help you guys access the platform and take your businesses to the next level. Joining Axial is a confidential exercise. You can join 100% confidentially. When you join the platform, you have total control over whether or not you connect with any other members on it. So far, we've got about 7,000 private company CEOs on Axial, and we have about 30 CEOs joining each week. And then just to give you a sense for sort of what's happening on Axial, last year in 2015, we had about 507 businesses close a transaction, either a debt financing, an equity financing, or an exit where they sold their business. And the total amount of deal volume was about $3 billion. So most of the businesses that are being financed or sold on Axial have somewhere between $5 and $75 million in annual revenues. So prior to starting Axial, I worked as Bill mentioned for a couple of other companies, and really my experience building Axial grew out of those prior experiences. I worked as a professional investor in private companies. I saw how hard it was for investors to analyze and evaluate private companies quickly and efficiently, and I also saw how hard it was for entrepreneurs to really understand what's the value of my business and who are the partners that I should be thinking about working with, and why should I be thinking about working with one partner versus another. It's a very, very opaque market. Valuation is not particularly well understood. And so the vision for Axial is to create a platform where entrepreneurs can access capital with a lot of transparency and with a lot of safety, and can learn about the process on their own time and at their own pace. Let me start to jump in now to like the real meat of the presentation. I think it's really important to just spell out what is it that really drives or determines a company's value at any point in time, and really help you all understand how that value is driven. There's a couple of things that go into it, but I think these 3 are really the ones that really, really drive the answer to what your company's value is at any point in time. The first is to remember that the value of your business is not based upon what it has achieved in the past. The past is only a proxy for what your business might achieve in the future. So when a buyer or an investor or a lender is looking at your business, the reason that they look at your historical results is not to value your business. It's to determine, it's a means by which they try to understand what is the business capable of achieving in the future. And the most important thing that investors, acquirers, or lenders are trying to understand is what is the profitability that the business will generate either in the immediate future or in the very, very long term if your business is earlier stage and still not profitable. And what is the value of that set of profits? And then what is the predictability with which those profits will actually materialize? So how easy is it for them as an investor or as a lender to really understand the visibility into that stream of profits? Now, The second sort of big driver beyond just understanding the importance of the future as distinct from the past is the true market-based value of your company at any point in time, particularly as a private company, is the value of the business is really driven by what the qualified buyers who are aware that the business is for sale are willing to pay for it at that precise point in time. That is what will ultimately drive the value of a business when you think about it from a market-based perspective. So if you hire a professional to do an estimation of your business's value, and they say your business is worth $10 million, that doesn't mean that you can go out into the market and ascertain a $10 million valuation from a buyer. It may mean that the estimation is correct, but at the end of the day, the value of your business at any point in time is driven by what a market of qualified buyers is collectively or individually willing to pay for it. And that's a really, really important thing that we're going to cover before we go to questions later. There's no amount of offline estimation evaluation that is going to ultimately replace what a group of buyers out in the market are ultimately willing to pay. And then I think there's a couple of things that are very important for entrepreneurs to also think about when they think about valuation. So when you're selling your business, when you're financing your business, it doesn't happen in some perfectly coordinated and synchronized way. The world is too chaotic and messy to have it be perfect. And so what that means is you may find that there's 4 or 5 different buyers for your business, but 1 or 2 of them are much further along in terms of understanding your business, or 1 or 2 of them are much less busy looking at other opportunities and focusing on yours. And that means that they're either able to give you an offer sooner or faster, or the speed of the offer is going to be more compelling to you. You may be more confident that they're actually going to close the transaction as opposed to walk away and leave you at the altar. They may offer you $10 million in cash, and the other buyer may offer you $10 million in stock. And there's a difference between those two. And so there's a set of financial considerations, but there's also a set of non-financial considerations. You may find that one of the buyers offers $20 million for your business, but you can't stand him, and you really want to work with the buyer who offers $18 million for your business. And really, only you as the entrepreneur and as the CEO can ultimately value those things. And those are the tough calls that you have to make when you go through this process. But in a nutshell, it's really those 3 things that are going to drive the actual value of your company at any point in time. So before we go back, before we sort of jump into some of these valuation frameworks, I just want to hammer in this statistic. This is from a great survey that was done in 2015 by KPMG. 36% of deal professionals identify challenging the forecasting of a business as the biggest barrier to deal success. So as an entrepreneur, one of the things you have to always be thinking about when you're thinking about raising money, selling your business, is how can I present my business in a way that maximizes the forecasted future performance of it? What do I need to be able to present to a lender, an investor, or a buyer of my company that gives them the greatest amount of visibility into the future financial performance of the business? Any work that you do to really improve future visibility and forecasting is going to be rewarded. It's a really, really, really good use of your time. And it starts with having really good financial management, really good books and records, things that can really help an investor understand how you see the business's financial performance evolving in the future. So we're going to finish the webinar focusing on market-based valuation, which is really where the rubber hits the road. But what I want to do is cover the 3 methods that you can use to estimate your company's value in the interim. So when you're not in the market selling your business, when you're not actively in the market raising money for your business, you need a set of tools to estimate the value. And that's what we're going to talk about right now. There's 3 pretty well-known and I think pretty tried and true estimation-based methods for valuing your business. The first method is called the discounted cash flow method. What that means is if your business generates $1 million in profit this year and next year and the year after and the year after that, the way that the discounted cash flow valuation method works is it takes the stream of profits that your business will generate in the future. And as you go further and further out into the future, it discounts those profits back to the present. So $1 million in profits today is worth more than $1 million in profits 10 years from now. The second method, and we're going to walk through the discounted cash flow model, and I'm going to give you a little free tool to do it at the end of the webinar. The second method is called trading comparables method. What this method essentially does is it gives you an ability to look at your business as if it were a large publicly traded company. So let's say you're a distributor of products into the healthcare industry. There are a number of very large businesses that are also distributors into the healthcare industry. For example, one of them is called Henry Schein, and they're the largest distributor of dental products into dental offices, and they're publicly traded. So if you have a business that provides, that is a distributor of products into the healthcare supply chain, you can take a look at a company like Henry Schein, and you can look at the way that business is trading in the public markets, and that's one way of comparing the value of your business to a much bigger version of your business. So you can learn how that company is valued by public market investors. It's a way for you to understand how your business might be valued by private market investors. And the third method is called transaction-based comparables estimation. Transaction comparables is something similar to trading comparables. What transaction comparables does as a method is it says, again, let's say you're a distributor of healthcare products into the healthcare supply chain. In addition to there being large public companies that in some ways are similar to your business, they're not identical. Obviously, no business is the same as any other business. But the transaction comparables, as opposed to comparing you to a public company, the transaction comparables method will screen the market for other healthcare distributor businesses and try to ascertain the price at which those businesses were sold. So, and then that builds and sort of establishes a benchmark for potentially how your business would be valued if you were to sell your business or if you were to raise equity in your business from a minority investor. So 3 different versions: discounted cash flow, comparing your business to large public companies, and then comparing your business to other companies that are like yours that were recently sold. Those are the sort of 3 estimation methods. So this, we're not going to spend too much time on this slide. It looks complicated, but again, I just want to walk through the discounted cash flow method because this is really the sort of foundation and the bedrock of estimation-based valuation for a business. When an investor looks at your company or when a buyer looks at your company, again, regardless of whether your business is profitable today or not, they look at it and they say, what will this business generate in the future in terms of its total profits? It will generate X amount of revenue, it will generate X amount of costs, and it will have a certain amount of cash flow that it generates. And the value of that cash in its totality, when you bring it back to the present day, is a range of value for the business. So if your business is going to generate $10 million in profits over the next 10 years, the discounted cash flow method takes those $10 million and it discounts the out years, year 2, year 3, year 4, year 5, for the next 10 years. It discounts them all back to the present day. And it says that the stream of cash that your business will generate over the next 10 years has the following value today. And that's how that investor is thinking about the value of your business today, based upon what it will produce in the future. So a very important aspect of the discounted cash flow methodology is making sure that you as an entrepreneur understand how much cash your business is actually generating. So cash is generated by revenues minus your expenses, but there's a number of accounting treatments that make that a little bit complicated. So there's a bit of a difference sometimes between your net income and your cash flow as a business. And cash flow is the most important number for valuation. The discount rate, which we show on this page, DR, is the percent by which the investor is discounting your cash flow in the future. So the reason why the discount rate matters a lot is if your business is generating $1 million in profits this year, but the certainty of your business generating $1 million in profits next year is very, very high, then the discount rate will be quite low. Maybe they will discount next year's profits by $1 million, or excuse me, by 10%, right? And so when they bring that back to the present, it's about $900,000. If your business, it has very, very unpredictable generation of profits and cash flow, then the discount rate is higher and higher and higher. Now, there's no right or wrong answer to the discount rate. This is a negotiation, and this is an analysis that you can do, and an analysis ultimately that an investor or a lender or a buyer is going to do. On the next slide, I'll walk through a couple of the things that really drive the discount rate on your cash flow up or down. So, for example, let's say you have a company that has 5 customers, but instead of all 5 customers representing 20% of your revenue, one of those customers represents 70% of your revenue. In that case, if you lose that customer next year, that's a big hit to your revenue, and it will probably generate a big hit to your profits. And so when an investor looks at your customers, they're going to really want to understand what is the certainty that your biggest customer is going to be a customer next year. And if the certainty of that is low or high, that meaningfully impacts the discount rate that that investor applies when valuing your business through the DCF methodology. So again, the more that you can do to demonstrate to investors, to buyers, to lenders that the certainty of your business's profitability in the future is high, the more compelling evaluation you can arrive at and you can negotiate for. Another thing that obviously matters very much is what is the profitability of each of your customers? Is one customer dramatically more demanding? Is one customer substantially more profitable and easy to serve and work with? Those things obviously matter a lot, the profitability on a customer-by-customer basis. There's a couple of things in here that I've listed, but the last one that I'm going to cover right away is the exogenous capital market trends. So unfortunately, as entrepreneurs, we don't live in a macro environment that's the same every day or every year. Sometimes the overall economy is strong. Sometimes the overall macroeconomic climate is positive. Sometimes it's very negative. Terrorist events, things like that, those things happen. We have no control over those as entrepreneurs, but those things drive fear into capital markets, and fear in capital markets raises the cost of capital for entrepreneurs. When investors are afraid, they tend to value businesses at lower prices. And when they are aggressive or bold or bullish, they value them at higher prices. And it's just something that's out of your control, but it's something that ultimately impacts the cost of capital for every business. The other two that I've laid out here are the overall predictability of your cash flows, which I've covered. And then the final one is financial preparedness. So if your business has put together very accurate and clean financial statements, that really matters to an investor. It's very hard for them to get comfortable investing in a business when they can't feel confident in the quality and the accuracy of your financial statements. That's why annual audits create a lot of value for entrepreneurs. It seems like a sort of a pain and an annoying expense, but when it comes time to finance or sell your business, if you've had your business audited, it creates a level of confidence in the investors that's hard for you to replicate without an audit. And in order to get an audit, you need to have your books and records in pretty good shape. So that's not the exhaustive list of discount rate drivers, but that's 4 or 5 of the most important. I'm going to just spend a little bit of time covering the trading comparables estimation method. Again, this is where you take your private company and you say, what is the most similar set of publicly traded companies to mine? How is my company most similar to a public company that's out there, or a basket of 4 or 5? And then you can go and you can use a variety of online tools to get an understanding for how that company is valued by big public market investors. So I've given you a couple of examples for how you can look at your business. Some businesses trade as a multiple of their sales. very often those are businesses in the technology industry. Those are businesses that are not profitable yet, where you can look at the business and if you look at large public companies, LinkedIn is an example. LinkedIn currently trades at 5.3 times the sales that it is forecasting it will generate over the next 12 months. What that means is every day in the public markets, this number changes and bounces around a little bit. But yesterday, when I was putting this presentation together, I looked up LinkedIn's valuation in the public markets. And based upon LinkedIn's forecasted revenues over the next 12 months, the business is trading at 5 times its next 12 months revenue forecast. There are some businesses that trade based upon sales. Businesses that are profitable tend to trade based upon the earnings or the cash flow of the business. So that's where you get into comparable valuation methods based upon price to earnings or price to free cash flow. So right now, Procter & Gamble, one of the biggest companies in the consumer product space, it trades for 15 times its trailing 12 months earnings. So as an entrepreneur, you don't really necessarily hear about these things all the time because you're just busy operating your business, but I wanted to sort of give you some exposure to how some of these things are talked about. So TTM means trailing 12 months. NTM means next 12 months. What that means for Procter & Gamble is if the business is trading for, let's say, the valuation of Procter & Gamble, let's say it's $15 billion right now. It's much bigger than that, but let's say that the valuation is $15 billion today. What that means is that Procter & Gamble over the last 12 months generated $1 billion in earnings. So it's trading for 15 times its earnings over the last 12 months. That's what that comparable means. So if you run a small, diversified consumer products business, you can look at Procter & Gamble, and it's a much bigger business than yours, and it's got way more diversity, et cetera, but you can begin to sort of think about and arrive at a valuation for your business based upon these large public companies that are much larger versions of what you're building. And then the final valuation sort of ratio here that I mentioned is price to free cash flow. And here I refer to 3M, which is one of the great American manufacturing companies. 3M is trading at 10 times its trailing 12-month free cash flow. So free cash flow is not the earnings of the business, it's the cash that the business generated over the last 12 months. And cash and earnings differs based upon when you collect. So if you generate $1 of revenue this month, but you don't collect until next month, you had $0 in free cash flow this month, even though you had $1 in revenue. So one of the things that investors care a lot about is not just the revenue that you're generating, but when are you generating that revenue? Are you generating it today? Are you generating it tomorrow, next month, next year? So these are different ways of looking at your business, and whenever you have the benefit of public market comparables, you can look at all of these large public companies that have all of this data available on them, and while they're much bigger than your business, the comparables are still useful for you as you sort of think about what should my business potentially be valued based upon these analogs. Third one, I think, is probably the most useful one for private companies, since there really is a big difference between big Fortune 2000 companies and small and mid-sized businesses, and that's called the comparable company closed transactions method, right? So what that means is that if your business is a manufacturer of industrial products, you would use historical transaction multiples that businesses that are similar to yours traded for when somebody bought the business or invested in the business. Now, sometimes this information is really hard to get your hands on because this information is not nearly as available as information on large public companies. And that's actually one of the reasons why I mentioned the value of an M&A advisor or an investment banker. So M&A advisors, as I think many of you know, they are in the business of helping private companies access capital or successfully exit. And in order for them to be good at their jobs, they need to be able to advise you on what the range of value for your business might be. And so M&A advisors spend a lot of time, or at least good ones do, spend a lot of time capturing this hard-to-find data on private company valuation and trying to help you understand, okay, if my business is a manufacturer of industrial products and this M&A advisor has sold 5 manufacturer of industrial products over the last 3 or 4 years, then he has information on the valuation of those businesses as determined by the buyer who ultimately bought them. And so good M&A advisors will share that information with you freely, and you don't have to have them become a customer. You don't have to sign them up and pay them a fee or anything like that in order for them to do that. They should be willing to share that information with you as part of trying to court you and turn you ultimately into their client. So that's one really good way to access some of this information. And then there's a couple of other online resources that I'm happy to share as well that are also available to you. So some of the questions that came in advance of the webinar were just sort of when should I be estimating the value of your company? My recommendation is that you do an estimation of the value of your company at least once a year. And the reason for that is your goal as a business owner, in addition to building a great company and doing right by your customers and your employees, your goal should be to grow the value of your company and grow the value of your company over time. Not every month, not every week, but over a long period of time, you obviously want your business to be becoming more and more valuable. And so it's a great way for you to just track your company's value and benchmark your company's progress if you spend some time once a year to do an estimation of the value of your business. And as I said, I'm going to leave you with some tools that allow you to do this yourself if you want to. And obviously there's also a whole range of professional service providers out there that will provide a professional valuation of your business if you want to spend even more time and money on it. But I suggest you do it at least once annually so that you can just be tracking and benchmarking your progress over time. And then if you're thinking about raising money or you're thinking about selling your business, it's really important that you go through this estimation process because it's going to be a really important part of the way that you negotiate with buyers or negotiate with investors. They obviously want to buy your business if they're excited about it, but they want to buy it for the best price, so that they have the most upside after the transaction is closed. And you want to make sure that you're getting full value for your business. And if you don't do the research and don't do the estimation methods that I mentioned, it becomes a lot harder for you to defend a valuation to them when you get into a negotiation or when your investment banker gets into a negotiation on your behalf. So it's really, really important to do this groundwork and this preparation work before you enter the market and start raising capital or selling your company. One of the other benefits of doing this on an annual basis is one of the things that you learn about when you go through this process is you learn about what are the real levers and the real drivers of your business's value. And so if you're doing this on an annual basis, you can start to really understand, okay, here's what I need to do over the next 3 to 5 years in order to really grow the value of the business. Here are the kinds of customers that I need to serve. Here's the kind of predictability that I need to create with my revenue streams. It just really, really helps to inform the way you think about prioritizing your time and really operating your business. And if you don't set aside some time once a year to do this, you just kind of get stuck putting out fires, and you're not necessarily focusing on the things that are building value. So those are the 3 estimation-based valuations. You can do those anytime you want. Right? You can do those today. You can do those tomorrow. You don't have to be raising money. You don't have to be selling your company in order to do those kinds of valuations. Now, market-based valuation is the other framework that I introduced at the beginning of the webinar. What a market-based valuation means is that you, as the entrepreneur, either on your own or in partnership with an M&A advisor, are out in the market meeting with investors or meeting with buyers and ascertaining bids in good faith from those investors or from those buyers on your business. And that is when you receive those bids from those different buyers or from those different investors, you are arriving at what's called a market-based valuation. It's what the market of buyers at any point in time, based upon your presentation of your business, is willing to pay in order to buy it or to invest in it. That's why I say this is really where the rubber hits the road. You can hire a valuation professional to tell you that your business is worth $20 million, but if you go out into the market and a whole bunch of people that you meet with say that it's worth 15, then that's what it's worth. So we're going to talk a little bit about how you drive this valuation up and how you drive the valuation of this in the right direction, and what's associated with doing this. What I want to make clear, though, is you don't want to do market-based valuations all the time. There's real reputation considerations associated with a market-based valuation. So if you go out into the market, you talk with a bunch of buyers, and then you don't sell your business or you don't raise capital, that's not the end of the world, and you can obviously go back to running your business. But if you keep on doing that, if you keep on going out into the market, once every 2 or 3 years, you can develop a reputation within your industry for not really being a real seller, but just constantly going out there and getting a litmus test. And then what ends up happening is buyers end up taking you less seriously. So you have to be very careful about market-based valuation, because you really need to be pretty confident that you actually want to do a transaction when you undertake this effort. So this chart here, this is, I think, this is the 5-year chart for Apple Computer. So this is the price of Apple's business, the value of Apple's business over the last 5 years. And the point that I'm trying to illustrate is that when you are a large public company, whether you're large or whether you're medium-sized or whatever, once you become a public company, the value of your business is measured every second. There is a large group of investors that are constantly buying and selling your company's stock, and every time that a purchase or a sale of your stock is made, the value of your business is being printed. That is a huge difference from the world of private markets, where entrepreneurs running private companies live. The value of your business is not being made transparent every second of every day. It's a totally, totally different environment in which you're running your company. And so when you decide to execute a market-based valuation of your business, you have to create that market of buyers. They don't exist out there. They're not trading your stock every day. They're not, using computers and, executing trades on your stock. It's a really hand-cranked conversation with lots of different buyers. And then they get familiar with your business, and then they say, I'm interested, and this is the price, and these are the terms, or I'm not interested. And when you can gather that market of buyers more or less at the same time to give you a point of view on the value of your business, that's when you start to arrive at a market-based valuation for your business. So what I say on this slide here is you will never, ever sell your company to a buyer that you don't meet. And so as the CEO, if you want to generate a full valuation for your business through the market-based approach, you have to be meeting buyers in your industry. And if you wait until you're selling your company, or you wait until you want to raise investment, you're putting a lot of eggs in one basket. It really behooves you to spend time meeting with buyers in your industry on an annual basis. You don't have to tell them that your business is for sale, but you should just be out there developing connections and relationships with them, so that when you want to assemble the market of buyers, you can do so much more quickly. This is also a critical role of an M&A advisor. The role of an M&A advisor is to bring qualified buyers to the table at more or less the same time, to really help arrive at a true market-based valuation for the business. Now, an M&A advisor cannot sell your business for you. They need you as the CEO. You're the only one who can really do it with them. And so M&A advisors don't really spend a lot of time working with anybody other than the CEO and the CFO, because without the CEO, you can never sell a company. If the CEO doesn't want to sell his company, doesn't want to sell her company, it doesn't happen. So you've got to be really, really committed to it as the CEO in order for it to successfully happen. As I said on this slide here in the third bullet, M&A advisors are in the business of selling companies and raising capital for companies. And so when you decide you want to finance or sell your company, if you don't have a relationship with a set of advisors who you trust, it makes the process of creating this market much harder for you. You're going to be doing it on your own. You're going to be waiting until the last minute. And so again, we always advocate at Axial that if you're thinking about raising capital or you're thinking about selling your company, you should be meeting with investors, meeting with buyers, and meeting with M&A advisors every year, even if you're planning on selling the business 3 years, 4 years, 5 years from now. The relationships that you build today make it much easier for you to create the market when you really want to get there. So So a couple of quick things here in terms of just how do you generate these successful market-based valuations and deliver a successful transaction. You should always be thinking about M&A advisors that have expertise and experience in your market. Never hire an M&A advisor without asking them to walk you through the transactions that they've done, the CEOs that they've worked with, and how those experiences relate to the business that you run. When it comes to buyers, there's lots of different kinds of buyers for your business today. It's not just people that are in your industry and that are competitors of yours. There are private equity firms that buy companies. There are family offices that buy companies. There are corporations in Europe and in Asia that are buying American businesses. And so you need to be thinking about the potential network of buyers very, very broadly and spending a certain amount of your time developing relationships with them. In many cases, a buyer will buy your company and use a certain amount of debt in order to finance the transaction. So to the extent that you've got high-quality relationships with lenders, that's going to help you as well. And then I think one of the sort of classic mistakes that a lot of entrepreneurs make is they use their same general counsel or their sort of normal corporate attorney to do the M&A legal work. M&A transactions have their own set of documents. They have their own set of legal nuances, and it really behooves you and it really pays off to make sure that you're not working with a generalist attorney when it's time to finance or sell your business. You really need to be working with an attorney and with a banker that have real experience executing transactions that are relevant to yours. One other thing that I didn't mention on this slide, but just a reminder, there's nobody else in your company that can be developing these relationships for your business. Your head of sales can't really do this. Your head of marketing can't do this. You know, the person in charge of your product development. There's really only one person in the company that really is responsible for developing these relationships, and it's the owner of the business or the CEO of the company. So it's not something that you can outsource. So again, I want to conclude by just going through this sort of framework of what is it that drives the value of a business. Remember, the past is not what drives the value of your business. Investors and buyers are always looking at the past only as a proxy for the future. So the more clear a vision of the future you can paint for them, the better the valuation of your business that you can get. Second most important principle of valuation is even if your business has got tremendous profitability, if you don't have relationships with buyers, if you don't have relationships with investment bankers who can help you meet those buyers, your business has no true market value. It only has theoretical value. When you're selling a private company, it always comes down to the connections and the relationships that you've built. So if you don't have those connections and relationships and you don't have an M&A advisor who's helping you develop those, it's very hard for you to convert your theoretical value into true market value. And then I think another area that that entrepreneurs tend to forget about or tend to overlook is there are all different kinds of buyers and investors out there. And some have great reputations and others don't. And some you're going to get along with really well and others you're not going to get along with really well. And others are going to offer you cash instead of stock. Or some are going to offer you cash, but they're going to offer you 80% of the value today and 20% over the next 3 years. There's all kinds of considerations that from just what is the value of my business in terms of dollars and cents. And you really have to remember that those things matter a lot. You're going to have to think about those things. Those things really trade off against one another. A lot of the best buyers, if you think about Warren Buffett, everybody thinks about selling their business to Berkshire Hathaway, or a lot of companies do. He's built a reputation for being a great buyer of companies. He's built a reputation for being fair, for paying quickly, for offering a fair price. And that reputation really helps him when he's in the market looking to acquire businesses. And not everybody behaves that way. So there are things other than financial considerations that really, really impact the valuation and how you think about who you want to partner with, whether it's an investor or a buyer or even a lender. Here are three just sort of really, really just key things that I think I've seen over my sort of career that really, really drive broken deals or take deals off the rails. The first is lack of financial preparedness. You cannot sell a company without well-prepared financial statements that present the history of performance and link the history of performance to a credible presentation of the future. You cannot go into the market successfully without having done your homework here. You've got to have your books in order. You've got to have an audit. Those things really, really help you. If you don't have those, ready to go, don't go out into the market. Second thing is make sure that you've properly assessed like the key issues from a legal perspective. How is your business incorporated? What are your customer contracts? If you have multiple partners or equity owners in your business, is all of that laid out on paper? If all of those were handshake deals, that's going to fall apart in a professional outside financing or exit event. So you got to nail down those things. And then I'd say that the most important thing in terms of really killing a good deal is if you only have a relationship with one potential buyer or one potential investor, and you can't bring a large group, 4, 5, 6, 7 potential buyers or investors to the table at the same time, makes it much harder for you to both close the transaction, also makes it a lot harder for you to get a full valuation for your business. And if you start focusing on any of these three things 3 months or 6 months before you actually go into the market to execute a transaction, you're going to see how unprepared you are. You've got to be starting years in advance if you want to get there. So we've got 3 quick next steps for you. These slides are going to be shared with you. The first is on the Axial website, we actually have a free valuation tool. It uses that discounted cash flow valuation methodology. So I've got the links here in the slides. It's those 2 blue links. The first link is an online tool, and the second link is actually a download tool. So you can just download the valuation template, and if you've got a copy of Microsoft Excel on your computer, you'll be able to open up the valuation template. And if you have any problems, you can just reach out to us, and we'll help walk you through it. Second thing for you is you've got to have a point of view on how financially prepared you are today to finance or sell your business. And if you're not, you need to lay out a roadmap for how you become prepared. Because if you go to market, try and do a valuation with a market-based approach, and you're not ready from a financial perspective, you will not have a successful outcome. And then the third thing for you is, as I know how busy you are, I'm a CEO myself, if you're not spending time each year connecting with investors, connecting with buyers, and connecting with M&A bankers who can help you, you're putting yourself in a position where when it comes time to do a deal, you've really, really got to rush, and you really don't want to be in a rush when you're making decisions like this. So I advocate that every CEO spend 5 to 10% of their year focusing on these kinds of strategic relationships and connections. I've got my email address here. It's peter@axial.net. And then I've got a link down here to join Axial for free. When you join Axial for free, you get access to those valuation tools, and you get access to a whole bunch of other content that's focused on teaching you how to prepare for financing events and teaching you how to prepare for an exit event. I'm going to start jumping into the questions now, but I want to make sure I check in with Bill and prioritize these properly. So that concludes all of my prepared remarks, and I'm excited to start answering some questions.
Peter, great job. Take a breath. We're gonna get right into questions here. We just got a few minutes for questions. You did a fantastic job covering a lot of the questions we got. A couple that stand out. Now, some people are saying, beyond financials, what should a service-based business do to enhance their value and their ease of sale?
So, service-based business, there's millions of different kinds of service-based businesses. So, but I think the most important thing to understand is in a service-based business, it's not necessarily any different from an asset-based business. Investors or buyers are going to look at what is the profitability of the business today or the profitability of the business in the future, and what is the forecastability and the visibility into that. So some businesses have huge assets. They have a lot of land, they have a lot of machines, they have a lot of hard assets. Other businesses have very few assets. Actually, Axial has almost no assets. We only have our people and our software. But we're able to generate revenue even though we don't have assets. So I think the key thing to focus on, whether you're a service-based business or you're an asset-based business, is what is the revenue and the profitability of the business that you can present to investors over the next 3 to 5 years, and how visible and predictable is that revenue. That's going to drive the valuation of your business much more so than whether or not your business has assets or doesn't have assets.
Excellent. You know, a lot of small business owners, especially small and mid-sized business owners, kill their profits to avoid paying taxes on an annual basis, but that's not going to fly when they're selling it for a multiple of their EBITDA. So how far in advance do they need to show? What do buyers look for as far as, is it 2 years in advance, 3 years in advance? When should they start changing that strategy and start paying some taxes to drive up their revenues and their profitability?
Yeah, I think that's a good question. I actually think that as long as you can present the true earnings power of the business, the true stream of free cash flows that the business can generate. If you're running your business break even, and the reason that it's running break even is because you're paying a dividend to yourself or to the other owners of the business every year. Good investors and buyers will understand that right away, and they will do what's called a recasting of your financial statements, and they will recast your financial statements as if you were not paying yourself out a dividend. And so they will look at those and they'll say, okay, those dividends are being paid out, but they don't have to be paid out. And so if we buy the business, we wouldn't necessarily be paying those dividends out. And so I actually don't think that that's that you have to do that way in advance or not in advance. I think the most important thing that you need to be able to demonstrate is that the business is generating free cash flow or is capable of generating free cash flow if you change the compensation of the owners based upon the dividend strategy that they've had. Again, I think good investors look at what is the true earnings power of the business, independent of how the owner has been compensating himself or the other owners of the business.
Excellent. We have a technical question. With discounted valuation methods, do you also add to the calculation the value of assets and deduct the long-term debt?
Let's see here. So the answer is you're not adding assets to a discounted cash flow model. The discounted cash flow model is already factoring in the assets that you have and the depreciation of those assets. So you don't need to be adding in those or taking those out. As it pertains to long-term debt, the long-term debt of the business obviously has interest payments associated with it, and those interest payments are reducing the free cash flow of the business. So if that long-term debt is going to be retired over the next 2 years or 3 years or 4 years, and you're going to pay it all back, then you should incorporate that into the cash flow forecast that you offer. Then once you've paid all of the debt back, then you can eliminate the debt from the DCF forecast. I hope that answers that question. But basically, you need to have a point of view on whether or not that debt is going to remain on your balance sheet or not. If you're going to retire the debt, then that's going to impact your cash flow. And then after you've paid down all of the debt, your cash flow is going to expand very quickly because you've retired all of the debt. So it should be incorporated into the free cash flow model already. But if you want to talk about that offline, feel free to send me an email.
Just one quick question, just time for one left. Now, a lot of times people are a minority shareholder or they're doing valuations and they've heard that for estate planning or for gifting, or minority shares can also be discounted as far as valuation for IRS purposes. What's a standardized discount rate for lack of marketability and minority discounts?
Yeah, it's tough to answer these sort of questions. Sort of what is the standard rate? I mean, I think that there is always a premium paid for control of a business and always a discount for minority. But it's really tough to answer that question in a standardized way. I'm happy to refer you to some resources that actually try and quantify this. There's actually a couple of resources that will help you try and quantify the answer to that. But it's really hard to sort of go on the record and give that a standard answer because it really is quite circumstantial.
Well, you've given us a lot to think about, Peter. Thank you so much. You did a fantastic job, and it's just a plethora of information. So go to axial.net and learn more about what Axial does. I want to remind everybody that there are 2 upcoming webinars on Friday, April 8th. The topic is going to be how to maximize the small business administration program to your advantage with Ami Kassar, the founder and CEO of Multifunding. And on Friday, April 15th, the 2016 Economic Paradox with Chief Outsiders CEO Art Saxby and ITR Economics CEO Brian Bolio, who will present the latest research and recommendations to maximize growth and profitability in 2016. Peter, thank you so much once again for a fantastic job. It was wonderful, it was enlightening, and I'm sure all of the listeners got a ton out of it. Thanks once again.
Oh, it's great to be with you all. Thanks, Bill.
All right, that's going to do it for Fridays with Vistage, and we hope you've enjoyed this webinar. Please send your comments in, and we'll catch you next time.